Hello options traders and happy Friday everyone. I wanted to post a video here for the stock traders in this group. I know we have a number of people who mostly trade shares of stock who are exploring the world of options to see if there are some advantages they can gain over their shares of stock. And my answer is always the same, absolutely yes. But options offer so many advantages that many of them are actually hidden. And one that a lot of people overlook is the mathematical borrowing advantage that you can get from using options. And I say it's mathematical because you're not truly borrowing money, like you're going to the bank and actually taking out a loan or borrowing it from the broker, but it acts in the same way. And that's important because for stock traders, one of the things they're always after is leverage. Shares of stock are expensive. And so to improve their performances, they're often looking for ways to get leverage, but those come with risks. The options remove those risks. So let's take a look at the mathematical borrowing advantage of options. So first of all is a little review of margin trading, and all stock traders are certainly aware of this term. But basically the way it works is that you have to deposit 50% of the total cost of your shares, and that's what's called the Reg T amount, short for Regulation T. So for example, let's say that you buy $10,000 worth of stock. You would have to deposit $5,000 up front, and you would then borrow the remaining 50% from the broker. But there's a couple of big dangers here. First and foremost, you might get maintenance calls, and that usually happens if your equity falls to 30% or lower. So even though you start out at 50%, they allow a little bit of wiggle room in there. But if you fall to 30% or less, you're going to get a call from your broker saying, you need to send in more money just to keep the position on. And that could go on over and over and over, especially if you get caught in one of these downdrafts like we did in October of 2018. You will also get charged margin interest, which isn't cheap. Risk-free rates are about 3% right now. Most brokers are charging closer to 9%. And every single month, your account's going to get debited for that margin interest. But probably the main point that I want to emphasize right now is that your maximum borrowing level is 50%. All right, that might not be exactly true if you want to account for SMA and being able to go down to a day trading account, but generally speaking, at least under Reg T, the maximum you can borrow is 50%. So what we want to explore now is, can traders do better with options? Well, if you're using a call option, you are really floating the exercise. You're floating part of that cost. So think about this. Call buyers have the right to exercise. You're not required to do it. It's a right. That's what you're paying for. So let's say, for example, that you buy a 1-year $100 call. Well, think about it. You are not required to exercise that for 1 full year. So even if you do want the shares of stock, you are floating that $100 payment for a full year. So you get to control the shares today and throughout the entire year, but you don't really need to pay for them until 1 year. So that is where you are getting a mathematical leverage. Again, it's not actually borrowing like it is on margin trading, but it's going to behave that way. And that's where one of the big advantages comes from. In a previous video in this group here, I've posted one on put-call parity, and one of the forms that we looked at in there says that a call option is exactly the same thing as shares of stock plus a put, combined with a short bond, which is the same thing as saying that we're borrowing money. So take a look at these two terms right here in the middle, stock plus put. That's insured shares of stock. You own the shares, but you also have a put, which gives you the right to sell your shares back. So you've got this embedded insurance policy on your stock. But you also have the short bond. And that minus sign out there just means that you have effectively sold a bond or borrowed money to actually buy those shares. So how does that actually play out if we're not really borrowing money? All right, so here we are at the CBOE's pricing model. This is the Chicago Board Options Exchange. And I'm going to use a European style option just to make the math a little easier here so we're not having to account for early exercise. And I'm also going to look at an extreme example of an out-of-the-money call. So here I've got the stock price set at 100, the strike at 120, so we're 20 points out of the money for this call option. I have 360 days to expiration, so we have 1 full year. Volatility is set to 20%, and the interest rate is 3%. And when we click on calculate, it tells us that the call should be worth $2.71 and the put $19.21. So the first thing to notice is that we are borrowing this strike price right here, right? Because I'm not required to exercise early. In fact, it's usually a big disadvantage to do so. So even if I want the shares in a year, I don't have to pay this for a full year. So again, I'm floating this $120 strike. Well, what's that worth today? Just take the 120 strike divided by 1 plus the interest rate, and that tells us that we are mathematically borrowing about $116.50 today. Another way to understand this is that if you deposited $116.50 into a bank paying 3% interest in 1 year, you would have the 120 strike. So today's value of this borrowing is $116.50. So we're starting out by borrowing $116.50 mathematically. Now notice what we can do with this money. I can use $100 of this amount to buy the shares because the shares are trading for $100. But that means I have an extra $16.50 left over, which I can then use and apply towards this put worth $19.21. So take a look at this. If I have a put worth $19.21 and I can apply another $16.50, that means I would have to owe $2.71. And that is exactly the value of the call. So this 120 call actually allowed us to borrow 100% of the stock's cost, something you absolutely cannot do ever in the world of stock trading. But we've also borrowed an additional $16.50 to offset the cost of our insurance policy, offset the cost of that put. And yet we will have no margin calls ever. That fear is completely eliminated. We will have no margin interest ever. And yet, not only are we controlling the shares of stock, we have insured shares of stock. So what's the option advantage here? Well, when you understand strategies, what you'll realize is that by changing your strikes, you can change the amount you're borrowing. You are therefore changing the amount of equity you're putting into the position, and therefore changing the leverage. So we can create any amount of leverage that you want. In the stock trading world, you either get 0 or you get 50%. And this allows us to create strategies that are not possible with shares of stock. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.